148.9 million ounces gone in a single year, the fourth consecutive supply deficit. The Silver Institute just confirmed it. 678 million ounces drained from global markets between 2021 and 2024. That's 10 months of global mine production vanished. Silver just hit an all-time high, $58.97 per ounce. December 3rd, 2025, 102% gain this year alone. And every solar panel manufacturer on Earth is scrambling for metal that doesn't exist. This isn't a bull market. This is stage 3 of a 4-stage pattern that's destroyed every commodity market that ignored the mathematics. Palladium, 2000 to 2020, 600%. Oil, 1973, 10 times in 7 years. Same pattern, same outcome. Physical wins, paper loses. By the end of this video, you'll understand exactly where we are in this pattern, why the solar industry is about to consume more silver than exists, and what happens when stage 4 hits. Here's the pattern. It's brutally simple. Stage 1. Abundance creates complacency. The commodity is cheap, available everywhere. No one worries about supply. Decades pass. Everyone assumes it will always be there. Stage 2. Demand surges, but supply can't respond. A new technology emerges. Consumption explodes. But mining takes 7 to 10 years to expand. Geology doesn't care about forecasts. Supply stays flat while demand doubles, then triples. Stage 3. Recognition of structural deficit. Markets realize supply won't catch up, ever. Inventories drain. Industrial users start hoarding. Physical becomes scarce. Prices begin breaking out. We are here right now with silver. Stage 4. Price dislocation and panic. Governments stockpile. Industries compete for remaining supply. The price doesn't rise. It detonates. Paper markets collapse. Only physical metal matters. I'm going to prove this pattern to you 3 times using 3 completely different commodity crises. And when you see it, you'll understand why silver is mathematically destined for stage 4. Palladium, 2000 to 2022. Stage 1. Throughout the 1990s, palladium was boring, cheap, hovering around $200 per ounce. Automakers used it in catalytic converters. No one cared. Supply from Russia and South Africa seemed infinite. Complacency. Complete. Stage 2. Early 2000s. Emissions regulations tightened globally. Palladium became essential for meeting new standards. Demand exploded. But here's the problem. Palladium is a byproduct. You can't just mine more. 75% comes from platinum, nickel, and copper operations. Those mines don't expand because palladium prices rise. They expand based on primary metal economics. Supply stayed flat. Demand tripled. Stage 3, 2019. The market woke up. 8 consecutive years of deficit. Russia supplied 40% of global production. In February 2020, Norilsk Nickel, the world's largest producer, suffered flooding at a mine and a concentrator collapse. 400,000 ounces of annual production. Gone. Anglo-American Platinum in South Africa shut down their converter plant. Inventories drained to decade lows. Physical palladium disappeared from markets. Stage 4. January 2020, $500 per ounce. March 2022, $3,146 per ounce. 600% in 24 months. Automakers panicked, started hoarding, paid any price to secure supply. Those holding physical metal made generational wealth. Those holding futures contracts, betting on paper markets, got crushed when exchanges couldn't deliver. Same pattern, every time. Oil, 1970s. Stage 1, 1945 to 1970, $3 per barrel, 30 cents for gasoline. The entire post-war economic boom assumed infinite cheap energy. Suburbanization, interstate highways, 2 cars per family, all built on the assumption oil would always be abundant and cheap. Stage 2, demand exploded. Europe rebuilt, Asia industrialized. But U.S. oil production peaked in 1970. America became a net importer. The North Sea wouldn't produce meaningful volumes until the late 70s. Middle East production constrained by aging fields and political instability. Supply couldn't respond. New wells take 5 to 10 years to develop. Demand kept climbing. The gap widened. Stage 3, October 1973, Yom Kippur War. OPEC embargo. Oil prices quadrupled in weeks. Not just because of the embargo, because the entire world realized cheap energy was over. Peak production had arrived. Supply would never catch up to demand. Gas lines formed across America. Industries shut down. Inflation exploded. Stage 4, $3 per barrel in 1973, $35 by 1980, 10 times in 7 years. Those who owned oil wells, tanker ships, refining capacity made fortunes. Those holding dollars, watching purchasing power collapse, got destroyed. The pattern held. Physical assets exploded. Paper wealth evaporated. Now let's apply this exact pattern to silver. Stage 1, complete. For 40 years, silver has been absurdly cheap. In inflation-adjusted terms, silver today costs less than 1980. 45 years of monetary expansion, industrial growth, technological revolution. And silver is cheaper. Why? Decades of supply exceeding demand, massive deposits developed, governments sold reserves. Everyone treated it as boring, complacency. Total, check. Stage 2, complete. 2010. Solar installations were negligible. Electric vehicles didn't exist. Today, solar is the fastest growing energy source on Earth. Every crystalline silicon panel requires silver paste. No substitute matches efficiency. The mathematics. Every megawatt needs approximately 20 grams of silver. Global solar capacity additions, 448 gigawatts in 2024. By 2030, projected to exceed 1 terawatt annually. That's 273 million ounces of silver per year, just for solar. Add electric vehicles. They use twice the silver of gas cars, 50 grams per vehicle. Projected EV production by 2030, 90 million ounces annually. Add 5G infrastructure, medical devices, electronics, AI data centers. Industrial demand hit 680.5 million ounces in 2024. The Silver Institute confirms this. Record high, 4th consecutive year. Now here's where it breaks. Global mine production, 819.7 million ounces in 2024. Only 0.9% growth from 2023. Supply is flat. Declining, actually, when you look at primary silver mines. Why? 75% of silver is a byproduct of zinc, lead, and copper mining. You can't just mine more silver. You mine base metals and hope silver comes with it. Base metal prices are volatile. Mining capital expenditure at multi-decade lows. No new projects. Supply equals inelastic. Demand equals exponential. The gap is widening. Fast. Check. Stage 3, active right now. According to the Silver Institute's World Silver Survey 2025, global silver demand exceeded supply by 148.9 million ounces in 2024. 4th consecutive year of deficit. Combined deficit from 2021 through 2024, 678 million ounces. That's equivalent to 10 months of global mine supply. Gone. Where did it go? Look at the inventories. COMEX registered silver. 2021, 400 million ounces. December 2025, 280 million ounces, 30% decline in 3 years. London Bullion Market Association. December 2024, 827 million ounces, near all-time lows, down 23 million ounces in a single month. Shanghai Futures Exchange, 70 million ounces remaining, decade lows. Physical silver is disappearing from global exchanges. This isn't normal profit-taking. This is a bank run. Industrial users see what's coming. They're stockpiling now before prices explode, and investors are waking up. Silver-backed ETFs added 200 tons in a single day in November 2025, highest level since 2022. The price confirms it. Silver hit $58.97 on December 3rd, 2025, all-time high, breaking the previous record from 1980, 102% gain year to date. We are deep in stage 3, the recognition phase. Industrial panic hasn't started yet, but the mathematics are unavoidable. If this is connecting dots you've never seen connected before, subscribe right now, because what I've shown you is just the surface. The solar supply shock is one symptom of a structural collapse that's going to reshape the entire commodity market. In the next video, I'll show you how deep this goes. The manipulation, the paper markets, the derivatives time bomb, all following the same pattern, all headed to the same inevitable conclusion. Subscribe, hit the bell. Because people who see the pattern early don't just survive, they thrive. Now here's what stage 4 looks like. Research published in Science Direct projects that by 2030, global silver supply will meet only 62 to 70% of demand. Solar demand alone could reach 10,000 to 14,000 tons annually. That's 273 to 373 million ounces. 29 to 41% of projected total supply. Just solar. Add all other industrial uses. Electronics, EVs, medical, grid infrastructure, total demand, 48,000 to 52,000 tons per year. Supply, if current trends continue, 34,000 tons. The math doesn't work, and there's no solution. Substitution? No substitute for silver and solar maintains efficiency at scale. Copper oxidizes. Aluminum doesn't conduct well enough. You cannot engineer around the periodic table. Recycling? Recovery rate from electronics below 20%. Too small per device to be economical. Solar panels last 25 years. That silver isn't coming back soon. New mining takes 7 to 10 years to bring a mine online. We don't have 7 years. The deficit is now. And silver grades are declining globally. Demand destruction? The only way demand falls is if the energy transition stops. The transition is mandated by law across Europe, China, and the United States. Trillions in subsidies committed, entire industries retooled. This is policy. Policy doesn't care about silver prices. So what happens? Stage 4. A major industrial player publicly announces they cannot source enough silver. Solar manufacturer, defense contractor, electronics firm, that triggers the cascade. Other companies panic buy. Governments secure supply for strategic industries. Remember, silver is in missiles, radar systems, nuclear reactors. Investment demand explodes as people realize this is the last chance to buy physical before it's unavailable. The paper market breaks. COMEX changes rules, restricts delivery, forces cash settlement. It happened in 1980 with the Hunt brothers. It will happen again. When physical decouples from paper, when the industrial bid meets the monetary bid, when solar panic combines with currency crisis, silver won't rise steadily. It will gap. $50? 70s. 5. 100. These aren't predictions. These are the logical outcomes of supply-demand mathematics in a market with no inventory buffer. Analysts are already projecting $60 by late 2026. Some forecasts show $75 to $100 if deficits persist. The University of New South Wales study warns the solar sector alone could deplete 85 to 98% of global silver reserves by 2050. 2050. That's 25 years away. But the crisis hits much sooner because it's not about reserves, it's about flow. Annual production versus annual consumption. And consumption is winning. You'll hear this time is different. Technology will save us. American exceptionalism. The free market always finds solutions. Let me destroy that delusion. Remember the 1970s? The most powerful country on earth, reserve currency, largest military, was brought to its knees by an oil embargo. Gas lines, double-digit inflation. A decade of stagnation. Power doesn't exempt you from physics, from geology, from supply and demand. Silver isn't a policy tool. It's a finite element we're consuming faster than we're extracting. When that imbalance hits critical threshold, price adjusts violently. The pattern doesn't change because we have better technology or smarter economists. The pattern changes only when fundamental mathematics change. And the mathematics are these. You cannot sustainably consume more than you produce. You cannot indefinitely expand demand faster than supply. You cannot maintain low prices when inventories are exhausted. And you cannot escape consequences simply because you didn't see it coming. Here's my question. Are you going to wait until the market breaks and wish you had acted? Or recognize the pattern, trust the data, and understand what's coming while there's still time? The choice is yours, but the window won't stay open forever. Silver sits at the intersection of 3 unstoppable forces. The energy transition consuming silver exponentially. The supply crisis with no solution in any time frame that matters. And the monetary crisis driving investors to hard assets as fiat currencies debase. When these converge, and they're converging now, the price won't rise. It will dislocate. I'm not telling you to sell everything and buy silver. I'm not giving financial advice. What I'm giving you is pattern recognition. Once you see the machine, you can't unsee it. Subscribe now. Because the next video reveals the complete manipulation history of silver markets. How paper derivatives suppressed prices for decades. Who benefits from keeping silver cheap? And what happens when that suppression breaks? The people who see the pattern, who understand the machine, who position before stage 4, they'll be on the right side of the largest wealth transfer and commodity markets in 50 years. Everyone else will wonder how they missed it. Don't be everyone else. Subscribe. Turn on notifications. The clock is ticking, and the vault doors are closing.